Hey guys, Jenny here. Today we're going to be talking with Stephen Bowdon from Academy Mortgage about what's going on in the financing world, especially right now with all the crazy COVID stuff. He's going to talk about changes in the market, what we can expect, and just a little bit about financing both purchases and refinances.
I work for Academy Mortgage, been in the industry for 17, 18 years. We are an independent lender. So you have your bankers, your brokers, and your independent lenders, kind of your direct lenders. A banker, so most people say, oh, I'm gonna walk into my bank, I'm gonna get a loan, that company's gonna fund my loan. You go to a broker, they don't have any money, they're borrowing other people's money. So they're a middleman. And so they're borrowing that same bank's money to do the loan for you. And then you have direct lenders who are using their own money, just like a bank. And so our company uses our own money to fund your transaction. What ended up happening when COVID hits is potential foreclosures, because that's the first thing that lenders think is, oh my goodness, are we gonna be foreclosing on stuff? So there was a really quick tightening of the market. Most independent lenders got rid of jumbo. FHA loans with low credit scores just went away. Your unique properties, manufactured homes, USDA, anything that was out of the box, your doctor loan programs, anything that was kind of being a portfolio type product, just gone. So then you fast forward to today. The nice thing that we're seeing today, and this is all positive, is I just got a new jumbo product back with not even 20% down, 15% down.
Wow.
Also, our credit score requirements have actually, because they tightened those up, a month ago, they've started bringing those back down too on the FHA, the low credit borrowers. Our 203K rehab loans are back. So a lot of things are coming back in little pieces. I don't know if we'll ever go back to that 560 credit score type product. I think it'll be a couple years till we do that. They want to make sure that people have solid credit, but there's definitely a difference today than there was in January or February. It's not that. Reserves are money that you have left over after you purchase. So let's just say you're bringing $20,000 to the table. They want to make sure you have money left over. It's kind of a fallback fund. And so it's important that, depending on what you're doing, jumbo requires 6 months. So if you have a $2,000 payment each month, you would need to have your $20,000 plus another 12 sitting aside. It is a flexible thing. So a lot of people have a 401k, some stock options through their companies, things like that. We'll use those as reserves as long as they have access to them. Most of those types of things you can do an emergency liquidation for. So that's really all we're looking for. Fed gives the Treasury permission to purchase mortgage-backed securities. So this isn't a bailout. So they're actually getting a return. So they actually are entering themselves into the market as an investor and buying mortgage-backed securities by the billions every day because we don't have those investors buying them right now.
And that's keeping the rates low.
And that's what brought our rates from that 5% back down into the 3s. Now is an amazing time to buy because these rates are so good. At some point, right now your purchases from the government is up here and the investors are down here. So eventually they're gonna have to back off on that and we'll have to become fully reliant on investors again. And I'm seeing a lot of clients go, on the refi front, moving to a 15-year at 2.5% or something in those really low 2s. One of the most important things, and if you talk to a financial advisor, they'll tell you the same thing. When are you going to be moving? How long are you going to be in that house? What is your plan? What your plan is determines if you should do it or not, and I'll go into that a little bit. So let's just say you're saving $3,000 a year on your mortgage payment through a refinance, and the refinance costs $6,000. You're going to break even in 2 years. That's when your monthly savings finally catches up to how much money you spent. Anything beyond that is your actual savings. So that's your break-even time. I'm getting multiple different types of refinances. So we're getting the people that are saying, wow, I'm at a 4.5% rate, but if I can get to a 2.5 on a 30-year, I'm at a 4.5 on a 30-year, I can get to 2.5 on a 15, I'm only gonna have to pay a couple $100 more a month. I'm gonna knock 10 years off my loan. Right. So I have a lot of people doing that. I have some people consolidating their first and second mortgages into one loan, especially with rates right now, because normally when you consolidate a first and second, the rates are a little bit higher, considered a cash out.
Well, I really appreciate it. Thank you so much for the information today.
Thanks for having me here.